Good afternoon, everybody, and thank you so much for joining us after lunch. My name is Anelisa Matutu. As introduced, I head up the Commodity Derivatives Division at the JSE. The next panel will discuss what's next for the derivatives market and lessons learned from the global market. And to give us insights into this topic, I'm joined by Helina Sumbhoolaul. Helina is head of dealing and is also responsible for overseeing the different activities undertaken across the market businesses in the region. Helina is also responsible for running the firm's Delta One business in South Africa. Her career in markets spans 15 years. She joined JP Morgan in 2009 and has worked across equity cash, prime and Delta One desks in South Africa during that time. I'm also joined by Roberto Pharo. Roberto heads up the derivatives offering at Peresec, the largest derivative broker by value traded on the JSE, and his experience spans in different asset classes. He has spent 23 years in financial markets, 18 of which have been with Peresec. Roberto holds an honors degree in business from the University of Cape Town. And lastly, Matthias, or known as Matthias Kempgen. Matt started his career at South Africa Futures Exchange in 1997, which was acquired by the JSE in 2001. He steered the modernization of legacy systems and enabled business efficiencies during his career at the JSE, and currently holds a position of Chief Information Operating Officer at JSE Clear. And to start off the conversation, I'll give a brief introduction. You know, the Futures Industry Association, FIA, reported a substantial increase in exchange derivatives, traded derivatives for 2023, approximately about 64% growth in global derivatives traded volumes. And this was largely driven by options activity, 98% growth. Most of this comes from Asia Pacific, largely denominated with over 100% growth. So in equity indices, as well as a surge in zero-day options trading. Now, of course, sadly, that is not the case here at home. We had pockets of growth in certain asset classes and a slight decline in the equity derivatives market. But notwithstanding that, macroeconomic conditions play a significant role in the vibrancy and the growth of the market. Of course, enabling growth environment also plays a fundamental role, which then leads us to our first question for the panelists, and I'll direct this one to Helina. The first panel touched on the regulatory changes, in particular Reg 8 allocations. So how have those changes affected your business?
Sure. Thank you, Anelisa, for the introduction, and good afternoon, everybody. Hopefully everybody's still awake after lunch. So it's been about 2 years now since changes in the Reg 28 came into effect, which basically affected the foreign allocation of SA pension fund from 30% to 45%. As we know, Reg K set limits in terms of what and where pension fund can invest members' money. In the last 2 years, I think we have seen a gradual increase of this percentage, and it's currently sitting at plus or minus 40%. So what has been the impact of this change? And I'm always a balance, so I'm going to take a very balanced view of this. So on the positive side, I think for asset managers, it has been great. They've been able to create more diversity in the portfolio by having access to a wider universe of companies, sectors, industries that is not available in South Africa. For investors as well, I think it's been beneficial because they've been able to tap into non-ZAR denominated investments that most people would not have access to, especially with index harmonization coming into play this March, which basically make our top 40 index SA Inc. As we know before, top 40 had more than 50% of offshore exposure. So that's been taken away from your investors. So I think that's on the positive side. On the flip side of it, obviously the unintentional impact of Reg 28 has been, like a total dry up of liquidity in our market that's already seen a reduction in the volume. I mean, last year we have seen almost 150 billion of offshore equity coming out of our market from foreigners. And that combined with Reg 28 impact, I think we've all felt liquidity really drying up in our market last year. We've all felt it, whether you're looking at, the futures market. I mean, if I look at the future market, top 40 futures, liquidity went down by more than 30%. And I think year-on-year volume on the JSE has also been down around 26%. But one would hope that, the net or the negative impact of this change has been felt. And unfortunately, there is no going back. So as an industry, I think we need to focus on how do we flesh out new products, that we can service our local investors to tap into these foreign, those offshore investments, whether it's IDX, whether it's notes format, whether it's new sorts of products that would allow us to keep some of this money onshore.
Thanks. And Roberto?
Thanks, Anelisa, and good afternoon, everyone. I think Helina covered the allocation issue quite well. I'll maybe just extend, into the products and the changes we've seen in the last 2 years. I think it was February 2 years ago. Definitely a large increase in, requirements for passive exposure offshore. And through some of the JSE products that have been made available even before the allocation changes, like the IDXs, the Quantos, and the Can-Do suite of instruments, lots of our clients have been using those products to gain offshore exposure. That's also extended onto hedging of portfolios. So where the clients are holding directly offshore, those who aren't able to get derivative clearing in the offshore markets, which can be a stumbling block, again, the product suite of the JSE has enabled those clients to get exposure or hedging to the likes of the S&P ETF, the MSCI suite of indices, and even individual single stocks. And, credit to the market makers and the JSE in that space. We've seen some very tight pricing. And I think that's one of the positives, in terms of activity in the local market on these changes.
Thanks, Roberto. And we heard from Matthew in the first panel that he also thinks that the 45% allocation is definitely not going to reverse. Perhaps the question then is, listing foreign currency denominated products, would that be a segue or a solution around this?
Look, it's debatable. I think if you look at the man on the street, this change is probably a positive one in terms of what the investor can hold in their portfolio. I think everyone's familiar with the returns. A lot of what happens in the market is outside, or fundamentally and structurally is outside of the JSE or this room's control.
Yeah.
I think last year S&P was up 26%. Our CapSwix was probably up 7%. And the dollar was 8% stronger. So you got a 27% swing, which is, I think, the second biggest in 20 years. So the stats aren't in our favor. So creating the right framework for when things do change is vital. And there are a number of ways to attack that.
Perfect. And, the South African derivatives market is relatively new in South Africa, born in the mid-90s. So what can South Africa learn from the global market to gain a comparative advantage? I'll start with you, Helina.
Sure. As a country, we need our investment universe to grow. We need our exchanges to get bigger, more liquid. We need our we need our weight in global indices to get greater, etc. I think Matthew alluded to the stats in MSCI, but if we take it 20 years back, our weight in MSCI EM was almost 14%. Compared to its current 3%. So I think we all have a very important role to play in trying to maintain our weight and relevance in global markets. I think we need to look at the markets holistically and think how we're going to boost supply and demand in our market. I think Merlin alluded to the Indian market. I also find it quite an interesting one. If you look at the National Stock Exchange of India, it was voted the biggest exchange for the 5th consecutive year last year in terms of number of contracts that trades. And it's actually interesting because the derivatives market is bigger it's more liquid than the underlying equity market. And a large portion of investors and day traders tap into the derivatives market to get exposure in stock instead of actually going and buying the physical underlying. And they don't have to worry about, stock borrow funding until, of course, its expiry. And volume in that market is driven by, a big investor base. And it's also driven a lot by electronic market making. So it's got quite a nice dynamic there. In Europe and the US as well, we've seen a surge of electronic option making, which has driven liquidity in that segment quite significantly. Obviously, I know that, our market got its own nuances, but I think there's definitely lessons that we can take from those markets. So looking at the supply side for our market, I think the most effective way of boosting liquidity is to encourage market makers, to participate in the market by some sort of incentive scheme. I know we have had engagement with the JSE with that, but I think for market makers, and unless we see some real incentive, especially if there is going to be electronic market making, which would probably mean tech bail for market makers and applying resources. So I think there has to be some real partnership there that would just get that initiative going. On the demand side, I think we need to promote a diverse set of an investor base with a strong focus on foreigners and enhancing retail participation. I would let Rob talk about the retail participation in a bit. But I think, as we discussed earlier, participation from local is going to be limited. Yeah. So we really need to focus on how to attract foreigners back in our market. So things like the JSE's SA Tomorrow conference, all the roadshows that corporates, financial institution that we do, I think all of that are very helpful and very relevant. I do think, though, this year that it's going to be quite challenging to attract foreigners until the elections are over. So, we just have to bear that in mind. The third aspect to look at is, if we look at the global structure, the global market structure, a big portion of volume is driven by low-touch trading. Mm-hmm. So I think our exchanges need to continue, investing in tech enablers such as Colo 2.0 to keep attracting those type of low-touch, high-frequency algorithmic, just to keep our relevance compared to the other markets. The fourth aspect is just, how do we increase our pool of securities and financial product, obviously by increasing our local and offshore listings. The JSE has been a good enabler there as well, I think, strategically allowing Hong Kong listed companies to pursue secondary and fast-track listings. So I think we need more of those type of initiatives. And lastly, I think moving towards T+2 settlement, I think it will add a lot of, efficiency. It will bring more efficiency to the market. It will obviously decrease the carry costs of having to deal with different settlement cycle between our market and Europe and US, who obviously settles on a T+2 basis. So I think all these things will really help to boost market participation and increase liquidity in our market.
Yes, and Roberto, on your side, anything in addition to what Helina has articulated?
I think, again, Helina covered most of the topics. We have lots of headwinds locally. And previously we were just competing for foreign investors' appetite into SA. With these regulatory changes, we're now competing for the local investor too. So, our market needs to set itself apart from others. And again, not to be negative, but the headwinds of economic growth, electricity issues, grey listing, have not made it easy. But again, those are largely out of the control of us. I think what is in our control is liquidity to some degree, price dissemination. I think that's a big one in derivatives, and central order book activity. There's still only one instrument that really trades on the central order book on the derivatives exchange, and that's something that we, as a collective, need to rectify. And with all these issues, it's a catch-22. The clients won't come until the price is there, and the price won't be there until the clients come. So something needs to give, and we really want to be solutionist, especially this year with regards to that.
Yes, and just touching on transparency, Roberto, one of our biggest challenges in the derivatives market and across all asset classes is really the transparent negotiation of price on screen. And we just seem to struggle to pull that liquidity on screen. So I guess the question then is are retail investors perhaps the key to on-screen activity? And also, what are their drivers and barriers to entry with respect to the derivatives market?
Yeah, so it's a very good question, especially given the growth in the retail investor in the derivative space in the last 3 years. I don't think they're the silver bullet, but I do think that on-screen trading and on-screen liquidity could be the silver bullet for the derivative exchange. For that, as a collective, we need to get together, and something has to give. And I think the likes of ourselves can't be scared of cannibalization or losing some P&L. You need to invest in systems. You need to give something back to the market in the hope of local and foreign clients coming. Just to give an example, I often quote when I chat to our clients. I think earlier this year on the 18th of Jan, Richmond was up 11%. And that's a stock that held 25% of the weighting in the top 40 at some stage last year. There wasn't one option trade in Richmond on that day. And that's a failing. I think it's a failing for the country and for the exchange and for the providers such as ourselves. So that is something we need to rectify. I think many participants here would have had a view on that instrument on that day, but because of lack of price discovery and dissemination, we didn't see any trade.
And Matt, maybe do you want to come in there just on perhaps the drivers of retail investors in the derivatives market?
It's a difficult topic. What we've observed in the derivatives market is really, in terms of what we see from a JSE Clear point of view, is that the retail portion is still relatively small. I think we've spoken about it at length on previous panels as well, that is a challenge that I think we're facing in South Africa if we compare ourselves to India, for example. I do believe from a product point of view, and obviously that is a market decision, not something we as a clearinghouse can impact. I do think there is definitely space for constructing products. We have had discussions around moving our contract sizes on the single stock futures to a lower nominal, but I'm not sure if that is the exact barrier to entry. I do believe we need to drive a stronger retail market through active engagement with the end consumer. I don't think it's a culture that we observe in South Africa very actively, and I'm not quite sure what the solutions are, but I do think it is down to every member in the broking community to try and attract that market.
Hi, can you hear me? Yeah. I could just add, I think, I agree with what Matthias has said. I think they do, retail investors do form an important part of the whole ecosystem. Mm-hmm. And I think whilst, of course, it's important for financial institution to impart financial knowledge in terms of what products they're selling, it starts, I think it should start at a very early stage. If we want the next generation to participate more, it needs to be policymakers, educators. It needs to form part of, our education, the financial literacy. If we really want to make a difference and, get more participation in that segment. So I think it needs to start at an earlier stage.
No, agreed. And education, of course, is very important.
And actually, just on that topic, Mike on the earlier panel just mentioned, it's quite easy to undermine the retail investor.
Yes.
And there's I saw a term like a pro-tail, which is professional retail investor. And there are lots of those in South Africa, and they're quite sophisticated. But, the crypto digital asset market is a very good example. Within a few minutes, on your phone, you can trade derivatives, on digital assets. So education is definitely part of the process and the right type of gearing and leverage.
And I guess the challenge to us as a collective is to bring that retail investor on exchange and do make products that are attractive for retail investors on exchange.
And I think also the modern investor, new way of thinking is, less about low touch, ETF type investment, and more about exciting, tangible, instruments that actually move. And it's a type of instant gratification mindset that shift that we've seen. And then just don't underestimate the retail investors' assistance in price formation and price discovery.
And then just staying on with Mads, 1 month into accepting securities collateral, and really well done for that. What is your initial assessment of the market's reaction?
Maybe. Yeah, it's actually been 2 weeks.
Oh,
So it's
Fresh from the press.
it's a service that's been long coming. As probably most participants know, it's something that we designed quite some time ago, and I don't want to mention the word RTEC, but that project
please.
initiated that thinking. It was then de-scoped initially, but we finally went live with it 2 weeks ago, like I said. And maybe just some context, what we've done, we've enabled the FX and ED, or equity derivatives markets, to allow participants to cover a portion of their IM obligations in, at the moment, govie bonds. That's the current offering, which obviously reduces cash pressures in terms of expensive cash funding and so on. And in terms of the total margin we've got in deposit, at the moment we're sitting at 35% as a maximum that participants can collectively pledge. We're using the pledge mechanism against their IM requirements. That amounts to billions if the service is fully taken up in return of cash to the market participants, which can be used for trading activities or otherwise. So I believe that is quite a key service. Looking forward, what we are trying to do, we want to extend, first of all, the percentage of that offering to make it even a higher percentage of the total portion of IM a participant can pledge against their IM obligations. And then obviously extend that to other asset classes as well. Like equities, for example, which is obviously a lot more complex if you think about concentration and wrong way risk, but those are things that I have in the pipeline. And then secondly, we've got 2 other derivatives markets, the interest rate and the commodity derivatives market, to extend that service into those markets as well. The service launch was really successful. I can just urge any participants who are out there who want to make use of the offering, engage JSE Clear, engage your clearing members. There is a conduit through the clearing member. Obviously, the CMS system or the collateral management system at Straight is the key enabler for making those securities available that then directly interfaces to the JSE clearing system.
Thank you, Matt. And I see we've got a question from the audience. Why do we allow off-market trading in the derivatives market? Is that off-screen trading?
Yeah.
Perhaps?
I'm happy to
Maybe
shoot.
OTC?
Go for it.
I don't know.
I think it's reported trade.
I think it's report-only trades. So the question, why do we allow off-market trading in the derivatives market? I'm happy to take that one. I think probably twofold initially. The one is that structures clients are looking for are quite customized in terms of strikes, expiries, and the like. It would be impossible, in our market for market makers to put up screen pricing, across a range of instruments, different strikes, different expiries. There's just not enough liquidity yet. And I think globally, if you, in the US, for example, you can just, type Apple into your Bloomberg and you can, ingest a strip of pricing across expiries. Even in that market, pricing for bigger trades is done off the market as report only. There are minimums there in terms of block size. And then secondly, I think on the bigger trades in the local market too, that kind of risk in a derivative structure, you can't hedge it quickly enough if you were to put the price on the screen. So I think we definitely should look to move towards on-screen trading in derivatives, but it's baby steps, if you like, and there's always going to be a place for both on-screen and off-screen trading.
And I think obviously, if we can facilitate more on-market, if there is more electronic market making, for example, if we get more market makers coming, but there will still always be a need, as Larry said, for off-market trades, especially if And the market is wide. If you can be making your market here, but then it's, another market maker could be there. So there's always nuances. So yeah, there has to be a combination of both.
And I suppose other trade structures that accommodate such big volumes. And then maybe another question, sticking to products. How can products and the market structure be improved to transform the local derivatives market? And I suppose this is for us from a JSE perspective to get some insights from you.
I think we've already discussed some of it. You know, I think we've said, you know, moving towards a T+2 settlement, having more market makers or electronic market makers,
Yes,
just to allow for more transparency and price discovery for investors. I think the one product that we can look at again is total return futures. With the ZAR overnight rate observation period being over end of last year, so we are actually can reference it in terms of our financial products. As we know, the OTC market is quite opaque and there's no visibility in terms of its depth. And central clearing obviously facilitates settlement and mitigates counterparty risk. So I think that's one segment that we can definitely try to tap into. Just last week, Eurex actually announced that they are expanding the product offering into the return future, and they're actually launching the first MSCI index next month, actually, just to meet demand in that space. So Eurex launched that product about 7 years ago, and they now have more than 320 underlying single stocks and several global index like the Eurostoxx, FTSE 100, etc. And I think the current open interest in that segment is at 125 billion. So it's been quite a success story for them. So that's, I think, one thing that we can collaborate on and see how we can bring, some of the flows back on exchange with regards to that.
And Roberto, any ideas on products that we could consider?
I think the product offering is already very good, on our listed market. In terms of the arrows in your quiver as an investor, you got exotic options, you can list as can-dos, customized baskets, options on those baskets, and then obviously the suite of indices. I mean, yesterday we priced a barrier option on dollar rand, and that can be listed as a can-do on the JSE, and I think that's fantastic for, the clients in this market. I think it's more about the client type and the market structure that needs to maybe, just be calibrated somewhat. So for a healthy market, we need some liquidity providers. We need some retail clients. We need hedge funds. We need institutions. We need some CTAs, local and foreign. And I think there's been a bit of an imbalance in that in the last couple of years. Again, most of it is structural and fundamental, but we just need to get the platform right for when it does shift. And it will. It's when you doubt the market the most that it's about to change. And I'm doubting it quite a lot right now.
And I suppose we've been doing that work collectively, right? Going out there, looking for international clients, looking at ways to try and bring liquidity in country.
Yeah, and I mean, I think we've got to realize that we're competing on a global scale. I mean, India's been mentioned, Brazilian market's been very successful, in converting, some clients to trading. Yeah. And I don't think we're far off. That some of the products you can trade, and credit to the market makers too. We're seeing some very, very good pricing, especially over the last few years in non-linear derivatives, which is fantastic. And these are being marked quite accurately. Again, credit to, Reba and the team. They've really done a good job on the valuation metrics. All these things are important to investors. Yeah. And getting those basics right. Sometimes I think the JSE, and it's like a backhanded compliment, they almost try too much. What you need to do is just focus on some of the basics, get that right, and then the rest will follow through. But I think there's lots of potential, obviously, and just need some good news locally, and maybe the election will be the catalyst for that.
For some volatility as well. And then just sticking with the innovation theme, Mats, I'm going to come to you. So what's next for JSE Clear?
I just wanted to comment on, what can we do to enhance the offering. Obviously, JSE Clear, first premise is to risk manage, Helina, you mentioned it, to protect participants in case of a default and ensure efficient markets. And that's our primary role as a clearing and settlement agent. But there's opportunities in the way we do our risk modeling. If there's opportunities to, within the mandates that we've got, to do margin efficiencies, we will have to look at that. I think that also stimulates activity into the market if the cost of trading, especially from a margin point of view, becomes, more affordable or more appropriate. I mentioned securities collateral, which is obviously key in diversifying the types of collateral we accept. I think that brings us on a global par if we compare ourselves to other CCPs that have had offerings like that already.
Yeah, I think that's fine. And whether it's, you want less friction in markets, and whether that's aided by collateral or more aggressive but responsible margining, incentives and lower fees, all those things help. So I think those are
good points.
applicable.
And then just sticking with Matt, has the withdrawal of ESMA's recognition of JSEC had any significant impact in the clearing space?
So I think it's important just to understand, obviously, the context of our equivalence loss through ESMA. It's obviously a direct consequence of FATF and the EU Commission blacklisting of South Africa. So that's obviously the key context, because in terms of the ESMA recognition, that is immediately the consequence of losing that equivalence in terms of JSE Clear. In terms of the immediate impact, in terms of ESMA, a very small portion of our flow is EU-based, so it hasn't been significant in that regard. Obviously, we're monitoring it carefully, but at the moment, the impact we've observed is very small based on the initial flow that we were comparing it to.
And I guess to Roberto and Helina, has there been any impact from the clients that you engage with?
Luckily, not that we have seen. I mean, we were quite concerned, but touch wood, no visible impact.
And of course, Matt, South Africa being on the grey list is really out of our hands. But we do know and trust that government is working towards implementing measures to get us out of that FATF list.
Correct. And obviously, as JSE Clear, the moment we are in a position to reapply for that recognition, we will be ready to do so.
And now, just looking where the global markets are moving, are ESG and sustainability derivatives the next big thing? So what is it exactly that the end clients are looking for?
I'm no ESG expert. We have a team at in our firm that does ESG research, and I know they're highly respected and do some great stuff. I think for derivatives, there's probably more low-hanging fruit, if you like, before ESG derivatives and sustainability derivatives. But I think the derivatives market is an extension of the equities market. So insofar as those themes and that demand exists in the equities market, it will filter through to derivatives. But I hope I'm wrong, but I don't think they're the next big thing in our market quite yet. I think they're probably still some time before we see that.
Yeah, I think from my side, obviously, we have seen interest from the global community in terms of exposure into those types of index. And yes, all the major index providers have their own suite of ESG/sustainability sub-index. But to Larry's point, I mean, if I look at the AUM for the global index compared to the ESG type of investments, is still relatively small. But I do think that we do need to keep it at the front, especially if you want to attract retail investors in the long term. But yeah, for now, I think the focus will be, on getting our, liquidity back, getting more CFTC approved futures, etc. Yeah.
Yes. If I may mention, Val already mentioned earlier in our introduction that the JSE launched a VCM market, voluntary carbon market, in November of last year. So we've got carbon credits and renewable energy certificates that trade in that platform. Please speak to me after this session if you're interested. and then coming back
Can I change my answer on that?
And then coming back to the derivatives panel, Matt, I'm going to ask a very interesting question here, and a question that I've been asked by my colleagues in the rest of the continent, particularly in the commodity space or commodity exchanges in the continent. is providing clearing services to the region a possibility?
Good, loaded question. So first of all, obviously JSE Clear is currently the only licensed clearinghouse and CCP for clearing of listed derivatives in South Africa. In terms of providing services more broadly in South Africa, that's a possibility since we were licensed as an independent clearinghouse at the beginning of 2023. But you've got to consider, I hate to mention the word interoperability, but those arrangements in terms of technical considerations and so on in South Africa are first of all very important. Now, if you move outside of the region, we're currently only licensed to provide services in South Africa, as I said. However, because we run a very successful clearing and settlement operation, so we are, may I say continuously, or we've often been engaged by other players in the region. And it becomes quite complex because the second portion of the question is really, can you provide systems rather than JSE Clear as a CCP, which is a very different discussion. Now, at the moment you provide technology, the question becomes a bit different because now you're looking at your own applications in terms of your regulator locally and the complications of providing possibly technical services to, call it another CCP that's licensed somewhere else, and the regulatory requirements that are attached to that, speaking about technicalities. So those are the complications. And we continue to engage, and we obviously very keen to offer the state-of-the-art services and systems we've got, but it doesn't come without complications to offer that to other regions. And I guess the regulatory requirements in terms of where the CCP looking for those services operates or is trying to establish itself becomes a key consideration. And obviously, foremost, our obligations to our regulator are very key in terms of our license conditions.
Yes, so I hear what you're saying is that the biggest bottleneck for now is regulation. When it comes to systems, we should be able to provide such services.
Systems are a possibility.
Yes.
I think what is important, though, to note as well, and this comes from the conversations that you mentioned, every region has got different operating models,
yes,
different risk management systems, settlement considerations, often settling in other currencies. Those are all complications that you need to bring into the conversations when you start engaging at this level. And the door is never shut.
Good.
But those are the kind of conversations that need to be had to find a viable operating model that works for both the foreign jurisdiction and the CCP that approaches us potentially, and our obligations to the South African market, first of all.
Thanks, Matt. I think that's clear. And then I see we only have 10 minutes left, so I'll just ask each of you to maybe share if you had two things that could help scale the South African derivatives market. What would those be? I know you've spoken about international clients, we've spoken about products, we've spoken about fees in previous panel discussions, but just the two, top of head, the two most crucial.
I think from my side, it would be, like encouraging market making. I think that's quite key because there has to be transparency. As an investor, you need to be able to see where, there has to be a price discovery. I think that's quite important. I'm just trying to think now, which is my second. I think bringing back foreign investors is quite important because, they are the key to bringing the liquidity back into our market. And unfortunately, I know our macro outlook is not that great right now, but I think we all need to really work towards that at any chance that we get.
Thanks, Robert.
I think Helina's spot on the screen and liquidity on the screen. Screen is my dream. That's just the one. And I think that'll go a long way to, just making people more comfortable and giving confidence to locals and foreigners, trading in this market. Then probably less brokers in the space. So, no, that's a joke. We like all brokers, and generally, if one of us do well, we're all doing okay. But I think foreigners, like Helina says, and then hopefully a better, local environment.
Matt, should I put you on the spot here?
Yeah, you can. So I think extending the CCP services to other asset classes is something that as South Africa, I think we're lagging quite behind. Obviously, there is some impetus that's from a regulatory nature that would certainly help in that regard. But the bonds market and the equity market moving to a CCP model, I think will add a lot of value to those markets in terms of protecting investors in the market. And then secondly, we touched on it, but it's the technology programs and modernization of our platforms. And I think one thing that we have learned is that doing that bite-sized and in a manner that is acceptable to the market, big projects are always all-consuming, and any technology improvements we do, and as a CCP we're not immune to that, we have to ensure that we pitch those and we conduct projects like that, which are inevitable, that we have to replace technology, and that we do so in a manner that the market is able to absorb that change at an acceptable pace, and also obviously the cost that's then associated with that being taken into consideration. I think for me those are two key things that we need to look at over the next couple of years.
Thanks, Matt. And I think I'll close it there, guys. Really thank you to the panelists for such an insightful conversation. Please give them a round of applause. I was expecting more questions. Yeah. Thank you.